Welcome to the Daily Update. This is being prepared Monday, June 13th, where we'll look at the action in the market today and then see how things look for June 14th. And before I get started, usually when I record these videos, I have a chance to go back and edit out some of the mistakes or when I trip over my words. I just don't have time to do that, and I have a lot of charts to go over today. There's so many changes, there's so many things I need to go through that I just kind of have to do one take of this video and hope that it's good enough and professional enough. So please bear with me in that if I trip over some words, if I stumble, if I have to go back and correct myself. In a nutshell, it was a very negative day, and now the S&P is in bear market territory. So let's go back and talk about what happened. We gapped so far down, we went down to S3, and that's not even calculated on the charts that I use. I had to go to a calculator, figure out what S3 was, and then add that to the chart that I'm going to show you. That is very negative. As the day went on, any rebound attempts were quickly stopped. Going into the close, prices fell below S3 and closed almost at the low for the day. We ended up being down 3.86%. Volume was above average, so we saw a big down day last Thursday, last Friday, and that was on above average volume. And then today, we also saw a big decline on above average volume. You can take that a couple of different ways. Is it climactic, meaning that everybody's freaking out and they're doing something and it's what everybody's talking about right now? Or is there some real conviction behind this and they're driving prices lower because of volume? Either way, you can make a case. The technicals are very negative and we're oversold. And I'll go through and point some of those things out. I changed this area to kind of a gold color because that's what everybody's freaked out about right now. Inflation and interest rates. That's producing growth concerns, not only within companies, but within the economy, within our lives, all over the place. There is a real problem with growth concerns, and then geopolitical concerns, which could come into the mix at any time, either on a positive or negative way, and I have some things I'll go through with that, and then earnings as they come out. What are some comments? It was another very strong down day. Just like I said in the last video, stocks tanked, interest rates went up, and the dollar went up. Everything else pretty much went in the toilet. There's speculation now that the Fed may raise interest rates 0.75% rather than 0.5%. That's what the market is really fixated on right now. Fear is extreme again, as can be expected. There were reports of the lockdowns in China. Well, they're starting to find some COVID cases again, both in Shanghai and in Beijing. So they might be locking some things down. And for those of you that know, I do teach online to China. I teach Chinese children English, and a lot of my students are going through a lot of this. So I get to hear some of this firsthand about what's going on there. There's a real lack of confidence in the valuations that are coming out because it's like, okay, we've cut the closer term estimates, but they're not really cutting the further out estimates. So even though we have an expectation of slower growth and possibly even a recession, some are feeling like there's not a real fairness going on when it's coming to looking forward at company earnings. And that's starting to cause some real concerns too. Massive losses for the cryptos. And I'll have a chart of Bitcoin to show you. And we're really seeing a lot of money and capitalization coming out of cryptos right now. There's also a real fear of margin calls. A lot of people buy stocks on margin. You have to put up, let's say, $10,000. That gives you the ability to buy $20,000 worth of stock. What you've done is you've borrowed $10,000. No matter where that stock goes, you still have to pay that $10,000 back. You might end up with $50, but your broker wants to be paid in full. And when it gets to a dangerous point, they start saying, okay, you need to put more money into your account or we need to sell everything right now. And that forces people into a situation where they have to sell when they really weren't planning on selling. And that kind of causes more of the negative tone that's been going on. Economic reports. There weren't any. There was one that came out, the Empire State Report, but that might be important to New York, but it didn't have really a national influence. We have now switched over to a new trend. The ADX has gone back above 20. The red line is way on top, so we are in a new negative trend. Naturally, the bias is negative and our momentum is negative. Let's go back and look at the day's session. We're back into extreme fear right now. And we had come above 25. Well, now we're going back down below 25. Here's the other gauge that we look at. Now, this is a few days old, and it's showing where we're more neutral when we take this other look and put all of these things together. I'm more inclined to think we're getting closer to the extreme fear, but you may want to split the difference between the two and say maybe we're not extreme, but we're not necessarily neutral. We're kind of on the verge of fearful to very fearful. Also, we're looking at sentiment. When it's in parentheses like this, that means it's a negative number, and it's coming down. We had been showing a lot more extreme down here, but this is now the current reading. The VIX really spiked up, both on a closing basis, and we even gapped higher. Looking at the bar chart, the VIX of the VIX is also starting to spike up and could get even higher than what it's been right now. We are really rising with the VIX, so I plotted an RSI on here, and we're starting to get extreme. Even with the pop-up, even though we could go a lot higher in the short term, we might have overdone it over the last two trading sessions. The Ulcer Index is starting to spike up, showing that there's more fear in the market. We're down into bear market territory. From the all-time high, we're now down 21.83%. This is kind of interesting. On a big down day like we saw, the equity put-call ratio, even though it was extreme, actually declined. But our 5 period is still advancing. It's also something that we've been seeing is that mortgage demand is starting to fall. You've got housing prices really going up, interest rates are really going up, and so people aren't as inclined to go out and apply for a new mortgage right now. And according to this chart, it's the lowest since May of 2000. Short interest. This is where people short the market. And we take that by looking at what is the percent of the market cap compared to the median price of the S&P. Just know here that it's very low. Usually, when you buy a stock, you want high short interest because they have to sell to get in and then buy to get out. That means on the sidelines, you have a group of built-in buyers, which can help prices go up. Well, we're seeing a rather low reading in the S&P right now, so we're not seeing what would be called a lot of short covering. Consumer credit. People are having a hard time making ends meet, filling their gas, putting gas in their car, buying food. They're running out of money, so they're having to turn to their credit cards to do this. And so we're seeing a real spike up in consumer credit. Existing family home prices, this is an Edward Yardeni chart, just shows how they're really going up. But interest rates are going up, and it's getting to the point where it's probably going to slow down at some point because people can't get a mortgage and housing prices are so very high. This is an interesting thing. I'm not trying to be political here, but I just ran across this where a lot of people are very critical of the current administration for not really seeing what's happening. And there was this graphic that showed that, wow, last 4th of July, everything was going a lot better. We actually decreased price. Well, then prices started to go up, and now what is happening is this was when Russia-Ukraine started. And yeah, there was a spike up, but we came right back down and resumed the overall uptrend that was already in place. So some people are really skeptical right now, saying, okay, don't blame it all on Putin. Yeah, it produced a short-term blip, but it's not necessarily what's behind what's happening. Now, if you want to take that to a political level, by all means, feel free. I just wanted to show you that maybe there's another side to what some people are considering in this whole argument. Another thing that I did is I went through and just looked at some headlines just talking about how they might raise interest rates 0.75% now. That was in the Wall Street Journal. And then down here, this is Bloomberg, where it says the favorite recession signal is back as curves invert. That's not entirely true. Some of the curves have inverted, but not the 2 to the 10, which is the one that a lot of people generally look at. And I'll have a chart to show you. Here's some other things too, showing that maybe they're going to raise 0.75%. Everybody's freaked out about inflation, which may bring on unemployment. Janet Yellen and the World Bank, they're now starting to admit that inflation is kind of here to stay. It's not transitory after all. Another area that I'm trying to include is called support and resistance. And some of this is going to be a little messy, and please offer some feedback about how you feel with this. But this is the same as the daily chart that I show you. But I have a number of different pivot points on here. The ones that I've used for the longest time are just called standard pivots. Well, there's another person named DeMark, and he's very respected in technical analysis and also produces some software that's very expensive. And he came up with his own way to calculate pivots. And then we can also calculate pivots based on Fibonacci levels. So over here on the right-hand side, these are the current pivot points because we want to use those specifically now for support. If we do see some kind of a rebound, this may turn into resistance. And I tried to make a blow-up image right here. These are the figures up in the upper left-hand corner, just to give you the actual numbers. And this can be kind of confusing, and you're playing around. It's nice to be able to show it in a graphical way, but we also want to know what the numbers are behind these different points. So let me know if you think this chart is useful. This is the machine gun chart that I call it, where these are past pivot points just based on standard daily pivots. And we broke through the long-term support. Other lows could also provide support as well. And we're in danger of coming down to another Fibonacci level, which I'll show you in another chart. This shows how we're coming down. We broke below this level. And then up in the right-hand corner, I just tried to include a blow-up of these different values. Hopefully this will be helpful to you. We've also, on a little cleaner chart, we're coming back down to a low that was set in 2021. Is that going to act as support, or are we going to end up breaking through that? That's almost 100% retracement based on this fib chart here. There's another chart showing that we've broken below what had been some pretty significant support levels. If you go back to the COVID low to the all-time high and a significant low that we set back in 2020 to the all-time high, we see that a lot of these lines match up with each other. Well, we've broken below both of those. So that could be quite negative. Now we're looking at possibly the 35.14 area. When we have a decimal, I tend to round up on these. Another looking at the weekly chart, this had provided support before. Well, we broke down below that. So this is a longer term chart also showing that we're having some real weakness right now. Fed watch. We have the Fed. They start meeting on Tuesday. They will conclude their meeting on Wednesday. We're seeing a bit of a shift in the probabilities, but right now there's almost a 97% chance that they'll be at 1.5 to 1 3/4. We're at 3/4 to 1 right now. So they're expecting a 50 basis point move. Here's the corresponding chart. But there's some fear out there that they may bump it up to 3/4. So that's kind of adding a lot of uncertainty right now. Looking at the July meeting, this had been a lot higher. Now there's an 80% chance that we'll be 2.25 to 2.5 after that meeting. There's still some folks that think we may not go that high. but this side is currently winning out, and here's the corresponding chart. And then the thing that's been kind of controversial is what's going to happen in September. And these numbers are dancing around. There was that scenario thinking that maybe inflation had topped and is starting to come back down. That got blown out of the water with the CPI report last Friday, and now we're seeing a continuation of interest rates being raised. And here's the corresponding rainbow chart here. Looking at some inflation issues. This is all gas formulas together. And just shows how we've now gone up over $5 when you compare them. Here's diesel, which shows that it continues to go higher and higher. Looking at the different sectors, every one of them was down. And energy was actually down the most. The one that did the best was consumer staples, and it was down 2.16%. And here's how they fared. The only positive sector now since the all-time high is energy. All the other sectors have switched negative, the way that I measure it on this chart. Some technical alerts. This is just a whole list here. The S&P did set a 52-week low. We went below 39,000. I'm just going through the S&P ones. Then below 38. We had a BPI that crossed below 30 in the S&P. And that's about it. So if you want to pause this and just kind of gander at all these negative things that happened, not a single positive one in the bunch. Intraday. Another thing that I'm going to try to start doing is this is the overnight futures that trade. And I say the futures were weaker, they were stronger. They start trading Sunday evening East Coast time, and that's right about here. And there was a gap lower from Friday's close. And we drifted lower and lower. And then down here in this corner, this is when the market opened, Monday morning. So this just gives you a bit of an idea of what was happening during the night. Here's the intraday chart where we just gapped down below S1, S2, came all the way down to S3, even dropped below that, tried to bounce back a little bit. Nah, that wasn't happening. Saw selling going into the close and closed just about at the low. Here's another area of support and resistance based on an intraday chart where I have all the different pivot levels, both resistance and support levels. And I didn't do a blow up of this because I thought these numbers were a little easier to see. But this will just give you some reference points. I can't do that on the other chart that I just showed you back here. I can on this chart. So let me know if this is helpful to you. Here's the chart that we usually look at. It just shows where we had broken through the long-term support. Now we broke through S1. We're down here. We're possibly looking at S2 at about 35.86. Technical overview. Nothing has changed here. The things that were positive are still positive. Negative, the things that were negative remain negative overall. Our trend, see, we had a really big upward spike with the selling, so the ADX has crossed back above 20. It's 20.37, but that's still above 20. It's also above the moving average, and the green line is really going down. So I'm saying that this is a new negative trend. The Arun's kind of going all over the place. It showed that selling really increased. It's pegged near the top. That means sellers are in control. But look at the weird thing that the buying did. It actually spiked up on a very heavy down day. So overall, our oscillator has actually been showing improvement. I wouldn't necessarily read too much into that right now. Looking at breadth, very negative. We overdid it, not only on Friday, but also on Monday. Our breadth is really starting to break down. Even though we had that positive bullish divergence here that we were working off of, that's pretty much off the back burner now, if not completely off the table and in the garbage. The advanced decline ratio is starting to get extreme negative. The new highs, new lows, holding up a little bit better, but my goodness, look at this long bar here. We just rolled over with the 10 period, with the 5 period and with the 10 period. Looking back at the 10-day average of highs and lows in the S&P, we're not necessarily extreme right now. It's not climactic. So this is holding up a little better, or this suggests that maybe we have more room to fall with this. Accumulation distribution, turning more negative now. The stock's above the 200-day simple moving average. It's going down again, but not necessarily at an extreme reading of when we saw other major bottoms. Short-term charts, overdid it on 1 day. Overdid it looking back 5 days. Force index, also getting pretty extreme pretty fast. So you could say that that's oversold. Looking back 10 periods, also extreme. The Swinland Trading Oscillator, based on price, getting extreme, looking negative, and could be near extreme based on volume. McClellan Oscillator, it was really extreme after Friday. It's even more extreme after Monday. The Stoke RSI, extreme negative, as is the Williams percent R. Moving average study, extreme with the 20, 50, and even getting extreme with the 200. Stochastics, short term, really overdid it to the downside. Still have a little bit more room to go intermediate term and have now rolling over on the longer term chart. Intermediate term charts, we're getting far away from the standard deviation price. Looking back 10 periods means we're getting far away from what prices should be, and we may be overdoing it. The Sean trend meter remains extreme negative, as does the CCI 14, and now the CCI joins in to the party. Chaikin Oscillator also is negative and not necessarily extreme. Chaikin Money Flow, believe it or not, is still positive, but rolling over and will probably turn negative unless we see some monster rebound. Ease of movement, looking negative across the board. Money Flow Index, also turning down. We're seeing a pickup in volume, so that's why this line is turning back up, both from Friday through Monday. Ultimate Oscillator, not necessarily extreme negative. Vortex, crossed back over negative and is below 1. Summation Index, declining based on price and volume. Pretty much our short to intermediate term oscillators have switched back negative. Slope, MACD, PMO, TSI, they're negative. The longer term ones, the KST and the TRIX, they are rolling over but haven't crossed yet. The stocks that are above their 50-period moving average is starting to get extreme, where we saw some pretty significant bottoms before. BPI had been holding up, boom, went all the way down, and it is extreme negative. PMO crossed over. This was actually led by a couple of days by the price and volume oscillators rolling over sooner. PMOs that are rising, extreme negative. Buy signals, declining. Those that are above zero, declining. Rate of change, looking back 50 periods. Not necessarily extreme, but still quite negative. The boom indicator, we went down pretty far, pretty fast, so we're a long ways away from the 50. We're getting further away from the 200, but not necessarily extreme yet. Connor's RSI, giving us an extreme negative reading. The triple exponential and double exponential moving averages, we are well below them as they turn down, and we're below the anchored moving average set back from the March 23rd low. That's the COVID low. This had been pretty good support. We broke that on Monday. TTM squeeze, really showing some weakness. It's still hanging in there positive, but not looking all that healthy. The percent B indicator shows that we've just been going down pretty far, pretty fast. So it's starting to give an extreme negative reading. The RSI in 14 period still has a ways to go, but 9 period, we're getting extreme. Different charts. Heiken Ashi, negative. Kegi, negative. Renko, negative. Point and figure, and it actually generated a new signal called a double bottom breakdown. It sounds like a cool dance, but we had some new zeros drawn in here, and this is looking more negative. Even though we have the blue line up here, the longer term trend is still positive. If we switch and see a red line like this, that could bode negative for the market. 3-line break, negative. Different trading systems, Elder, based on the S&P, negative, with a red bar, as is the SPY. SAR is negative. We have 2 dots now. Go, no go, back to a dark purple. That is negative. Longer term, this looks at the Amex, the NASDAQ, and the NYSE. So you've got a big pool of stocks here, and just looks at a moving average of their 5-day highs and lows. Hasn't necessarily turned positive. Hasn't necessarily gone extreme negative, which may suggest that it's holding up, or we still have more room to fall. Looking at our longer term moving average study, we are really extreme with the 50, getting extreme with the 150 and the 200. And then I included a longer term look on this chart just so you can go back and compare other times when we reached these levels. Here's a chart that kind of shows what I've been showing all along. You may want to pause this and look at it. It has a lot of extra annotations on here that I'm not going to really go through. But this is a weekly chart of the S&P going all the way back to the 1930s. This is a 200 period. So that's a 200-week moving average. So this is ultra long term. And then it just shows how we're still above that, but we could be in danger of dropping below that. But other times, it can act as support. And if we get below it, there have been times when it may act as resistance as well. But right now, we're looking at it more from a support standpoint. Our special K is starting to roll over. It never did go positive. It tried to turn up, but not very good there. Broad market, diamonds, negative. Qs, negative. Vixen spiked up and could actually run a little bit higher than it already has. The broad market, dollar, just is going back up now. So this scenario on the next chart, we pretty much can throw that out now. We thought that we had spiked up, we're coming back down. Well, we've now exceeded the May high. Here's just a correlation between the S&P and the dollar. Shows they have a really strong inverse relationship. The dollar's been going up, the S&P has been going down. Oil didn't really freak anybody out. I mean, it freaks out if you look at the price, but it didn't skyrocket like it has been. And then here's a chart, and I actually made a mistake on this. I had the colors opposite. The black line is the S&P that's been declining. Oil is the red line, and they have a pretty strong inverse relationship. The gold futures were down overall. You would think, with everything that's going on, that gold would get a fire underneath it, but it just hasn't happened yet. The gold ETF is also down 2.64%. Here's the long-term look at that chart. Silver is also really starting to break down here. And here's the longer-term chart of silver. The euro against the dollar's back in the lead a little bit. The euro's at 104.1. The dollar's at 104.95. So they're kind of neck and neck there. 0.85 difference. Japanese yen is still showing some weakness, as is the euro, with the dollar coming back and showing some strength. This is what's interesting. Cryptos, back in November, they had a market cap of 2.9 trillion. As of this morning, right before I started recording this, we're under 1 trillion. So that's how much has come out of the whole crypto universe. And Bitcoin's even down. I think it dropped under 23. Here's a chart. This is a closing chart, and this is an index that's based in New York. It's not a live chart that updates 24/7. I just wanted to show how we have broken down here. It might even be below 22 now. I didn't look at it that close. Looking at bonds. Bonds are really going down based on price. These are corporate bonds. And we're looking at some fib levels with yields because we're starting to break above what had been pretty good resistance. There's the 10-year. It's really starting to shoot up as well. Total bond ETF just going down big time. And here's the World Bond Index, which just continues to crater. Here's where we have a couple of the yields inverted. The 10 to the 2, it's slightly negative right now. 10 to the 3-month, it's still holding up. The 30 to the 5, it's gone inverted. 10 to the 5 is inverted. When you look at the 10 to the Fed funds rate, it's still hanging in there fairly well. And then this just shows the correlation between the 10-year yield, which has been going up, and the S&P, which has been going down, and they have a very solid inverse relationship. And here's the same chart of the 10-year yield in case you forgot what it looked like. 10-year Treasury yield is starting to break above what had been pretty significant resistance in the past. And here's the correlation showing how tech has been going down. 10-year yield's been going up, and they have a really strong inverse relationship. Government yields, we're just like shooting to the moon here, and they're all crossing and just bunching up with each other. And even the 3-month has really spiked up. Then this is emerging market bonds. And this is why we see the World Bond Index look more negative at times, because they're really having some trouble. And they're coming back down here. And it says the emerging market bonds trading at Lehman lows. That was when the financial crisis hit. So this is starting to get some attention in the bond market. And here's just a look at so far how internationally rates have been spiking up, except for Japan. Positive possible scenarios. We kind of have to take them off the table. We're still spiking up, at least with this one. The 2-year yield, the correlation just shows that the yield is going up as bond prices are going down. Sometimes that has bottomed out before we get ready to turn, but we don't really know that's going to happen yet. The small cap index, it was down really heavy, but on a relative basis, it was down, but it's still outperforming the S&P. So when we look at our small cap spike here, yeah, it declined a little bit, but it still could be hanging in there. The staple sector was also down. So we are spiking back up, but we have not exceeded the spike that we seem to think might be the ultimate spike. But if this keeps going up, it's going to take out this spike right here. So this is a lot more of a warning flag right now. We never saw the follow through with price. This is starting to spike again, so we kind of have to wait and see how this plays out. The Copic curve, we're starting to lose that. Mass index, it just continues to flounder and hasn't really done much. The bottom fisher, it's still positive, but it's starting to roll over. So what's our outlook then for Tuesday? The technicals, we are negative and oversold, but we can go even more oversold than this. I think the futures were up over 0.5% when I started recording, so maybe we'll get a bit of a bounce. We have some economic data coming out that could really shift things, and just because we have a positive open doesn't necessarily mean we'll have a positive close. Things can always shift. Sentiment is extreme and quite fearful. We have the NFIB Small Business Optimism Index. Gee, I wonder how that's going to go. The big report on Tuesday is the PPI. We had the CPI on Friday. We're getting the PPI on Tuesday. And then Russia-Ukraine could be positive or negative, probably more negative, but that could come into the picture and play into the markets. The supply chain issues that I talked about in China, where they're starting to lock things down. Inflation and interest rates, that's the big concern. Oil, which kind of behaved a little bit on Monday. Earnings as they come out. We've got the Fed meeting right now. They'll adjourn with their announcement. Then there'll probably be a press conference after that, and the market can shoot all over. And then the longer term situation with Japan, which I really haven't addressed all that much. So our scenario, we are negative. That's why it's in gold, because of all the things that I just talked about right there. The technicals, they're negative, but getting oversold, if not already oversold. What could help us go up? My goodness. Just a disbelief that it's not going to go up. And that's more like a capitulation type of a feeling. And we are very oversold. The possible positive scenarios, not really on the table right now. The spike is still there, but we could see an increase in the 2-year yield relative to the S&P and blow that spike out. Then the technicals, which are negative. So that's why I'm trying to show a lot more of the fib retracements, possible levels that we would hit that provide either support or resistance. And then we're not neutral anymore because the ADX has gone back above 20 and it is negative. So our conclusion, not hard to make here. We are negative overall. Short term, negative and oversold. Intermediate term, negative and oversold. But and you're going to love this, we could even get oversolder from here, or we might get a bit of a bounce. Long term, we never did come back to looking positive yet, so that remains negative. So thank you. Have a wonderful Tuesday, and I'll prepare the next video after Tuesday's session. Let me know what you think of some of these charts. Are they hard to read? Do you get some insight from them? Do I need to switch up some things of how I do that? Again, please forgive my stumbled words and pauses and mix-ups and things like that. I've got to get this video ready to be uploaded just as soon as possible. And yes, I'm dragging this out on purpose so that I don't put the end cards in on the YouTube upload too early. So have a really, really good Tuesday.